Hey folks, keep coming on the door. We're going to get things going here real soon. We've got a great webinar for you today. We're going to be talking about farmland values based on recent sales that the Halderman companies put on. We're going to also talk about cash rents and the rates that we're seeing based on contracts coming in. We're going to be talking about money. We're going to talk about farmland values. We're going to be talking about the farm economy and what that's doing. And then we're going to get into our keynoter. That's going to be Anna Barsky with the IPX company talking about tax-deferred real estate exchanges. So go ahead, grab yourself a seat, pour yourself a coffee or a Coke if you're me, because coffee sucks. And then we're going to get ready to do this. It's going to be a great presentation. You're going to love it. So go ahead. We're going to start in about 30 seconds.
Good afternoon, everyone. Welcome today on behalf of the Halderman companies, and glad you're joining us. I think we've got a couple of nice topics that should spark a lot of conversation. Emma Thomas is monitoring our chat today. So if you have questions, just type them into the chat and she will make sure Damien and I don't miss those, and we'll try our best to get them answered.
All right. 15 seconds, we'll get going. So we're gonna have a big topic. You're gonna like this. All right. Hey, welcome to the Halderman Maximizing Your Farmland webinar series. This is my third time joining, and we've got a great one for you today. As always, we've got expert analysis, we've got numbers to share, we've got experiences to share, and we're going to make this very, very informative, insightful, and most importantly, applicable for you in your farmland investing or your farming operation. Howard Halderman is going to kick things off. As I said, we're going to talk about cash rent rates. We're going to talk about analysis of the farmland marketplace based on also all the results. They've had a lot of sales. If you get their newsletters like I do, some big, huge chunks coming on, because you know what? When there's big numbers, that brings out big, huge chunks. I'm seeing like 600, 500, 300 acre chunks, kind of a cool thing. So he's going to be sharing that with us. And then after we hear from Howard, we're going to go to Anna Barsky with IPX talking about 1031 tax deferred real estate exchanges. Maybe you have a need for one. Maybe you have questions, and that's why she's here. Howard Halderman, you're going to tell us about all the sales. Man, I get your emails. Your crowd is on the run. This is the hot time of the year. You've been all over the Midwest mostly. You've got sales going on. I get your emails, and it takes me 5 minutes to go through each of them. None of them have been right next to me, but you've been all over the place. Some big sales, some big results. Why don't you lead us off? Which one you want to go with first? I think farmland sales is a way to go, and then we'll get into cash rent. So what are you seeing?
Sounds great, Damien. You comment about volume, and yes, we've got a busy March. Honestly, February was fairly slow. One of the things I've noticed over doing this 35 years, you start to get a breadth of perspective. And back when I started, we did a lot of sales Jan, Feb, March. And it was kind of after the first of the year, you get through Christmas, and then we'd have a number of sales prior to planning. And that has changed. The last 3 years, Damien, we've seen a whole host of sales come on in November and December. And we certainly saw that happen again last year. So it's been an interesting marketplace, and I think we'll talk about some of the dynamics that we have been experiencing, and I think folks will find this fairly up to date and enlightening.
So by the way, when last we talked, it was December. You had some information. You've done a fair amount of sales. February, that you said, was a little softer than usual. If someone is on here and they're thinking about selling and they're thinking about employing your services to sell, did we bump up and start doing stuff more like October, November, because there was this idea, get the money before it's gone. If you wait until April, the money that was going to buy these farms already went away. Is there a strategy in going earlier?
I think the going earlier, there's a little bit of that. We want to get it done before the market might change. We know the market's at the all-time high, so let's get it done now. So I think there's a degree of that. I think also today's society just we move more quickly. Information flows more quickly. Social media, all the types of things that are out there. I think people make decisions in the summer. We're going to sell at the end of the crop year. Yep. Let's just do it in November and December. This year that paid off. And I think as we get into the slides here, I will show you very quickly. First of all, I wanted to start with this slide. This is the Federal Reserve Bank of Chicago and their most recent publication, which came out a week, 10 days ago. And, I want to sound like the federal government, Damien, because that makes me sound like I know what I'm doing, right? Farmland values are still going up. They're just going up at a slower rate of pace. So a lot like inflation, we still have inflation, but it's at a slower rate. And this really documents that. I threw out the Wisconsin bar on this, but you might notice that Indiana was only up 7% year over year, January to January, as estimated by the bankers in the Federal Reserve Bank of Chicago. That was 16% when we did our seminar in December. And we went back the previous quarter, it would have been 22%. So still going up, but at a slower rate of pace. And if you look at the far left, Iowa actually showed a decline in the fourth quarter in land values. So that's really where we're going with the discussion today is talking a little bit about some of that weakness. Now, just to revisit our sales data, we go back to 2021, and I put this in. A lot of our listeners have seen these slides before. The blue line is all of our individual sales of cropland, 80% cropland or more. We throw out sales with a lot of woods or buildings or something that might skew it. But this is just pure cropland transactions. And then what we do is we divide the sale price per acre by the productivity index of the soil, so WAPI, for lack of a better term. And we come up with a $70 per corn bushel productivity index. And for 2016 through the middle of 21, Damian, we traded at $50. And that's on the left-hand side of this chart. Mm-hmm. And then due to inflation, higher commodity prices, and low interest rates, boom, we jumped to 80 overnight in the middle of 2021. 40% increase in farmland values, which is highly unusual. Usually we go up 4 or 5% a year over a long-term basis. But that was the impact of inflation on farmland. Now, in 2022, a lot of folks have seen this slide as well. We traded right in the mid to low 80s all year. We saw more volatility at the far end of the year in the fourth quarter. Interest rates were increasing at that point in time. Still had high commodity prices, but as interest rates increased, we saw the same highs in the marketplace. We started to see deeper lows. And that volatility then continued right into 2023. And when we last spoke, Damian, I had a little bit of data in the fourth quarter that I showed, but I've got more of that now. And what I've done is when I've gone back and looked at last year, you'll note there at the bottom of the chart, we have the different quarters. And, Q2 is always the slowest quarter in terms of volume because that's planting season. We try to avoid that. Q3 was a big quarter compared to the last couple of years. It was also probably the most negative, if I want to be negative in terms of the sales. And you'll look at a lot of the sale results were below the trend line throughout the third quarter. Well, if you think back to the third quarter, Damian, what didn't we know? It was super dry in August and September in most of the Corn Belt, combined with the fact the Fed had not said, we're done interest rate increases. We're still going up. And I think those two factors led to some unknowns for folks. And it was just really a question mark. I don't know where I'm going to end up this year financially. I don't know where interest rates are going. And I think there was a little foot off the gas in terms of farmland purchases.
You touched on this in our December webinar that it wasn't that fundamentals had really changed. It was that there was uncertainty, which is a fundamental. You and I both get the information from like the Purdue, agricultural economics. They talk about the farmer sentiment index.
Yes.
I know you've got a graph, and maybe you'll show it later. You're still talking about 55 to 60% of farmland is bought by farmers, not outside investors. And so farmer sentiment plays into it, and farmer sentiment also might affect. So I think that's what you were referencing in December. And now the data has become more clear because a couple of months later we were seeing it. So, and also the interest rate environment. Most of the sales seem like they're using a lot of cash. You would think interest rates don't matter, but it sure as heck did affect sentiment at the end of Q3, early Q4, I think is what your chart's showing.
Exactly. And then as we got into November and really into December sales, look at the far right side of that graph. Every sale was above the trend line. And so we ended the year last year with a lot of strength in the farmland market. And I think it was because a couple of things became known. Farmers, and I've made this comment in 30 different seminars this winter, you found bushels, didn't you? And I look around the room and they're all shaking their heads. Yes. Yeah. We got 20 more bushel of corn than what we ever expected.
Yep.
And so that became known, combined with interest rates. The Fed basically said in early December, we're done going up. We're not going down yet, but we're done going up.
Yep.
And I think that led to some positive attitudes. Now, here's 24. So this is why you come to this, because this is an up to the minute presentation. This includes all of our sales through just a week ago. And you can see we started the year continuing strong. Now, to be fair, this isn't probably, the statistics in me would say you don't have enough representative samples in here. But we're still trading on average above $80. But the trend line is down, which I think one would expect. Corn prices are down, what, 60 cents since the first of the year? Soybeans down $1.25. And interest rates have not moved. They haven't gone up, but they haven't gone down either, Damian. So our sales would suggest that if you wanted to sell today, you're probably selling at the all-time high. But I would suggest there's also some leading indicators that we might be looking at some weakness.
So looking at this, Howard, here we are. It's the beginning of March. Your data looks like it's about 12 data points, and that's like you said. You grabbed the 12 farms that aren't the ones that have some statistical anomaly, meaning it wasn't like all forested or something like that. So using these 12, one might say, well, that's not enough. Well, yeah, a sample set of 12 versus a sample set of 100 is probably, but what I'm seeing is there's still volatility. There's still variation. If I'm a buyer, I want to be at that one that just went not too long ago. That's under $60 per whoppy, as opposed to the one that's pushing 120. And so, what's interesting to me is that the trend line is down, as your chart shows, but there's still a great deal of variation of dollars per whoppy.
There is
Dollars per, and what that means, dollars productivity, I think, is the best way to tell the listener.
Yeah, and I think what you're seeing is buyers are being a little more choosy. And because of higher interest rates and lower commodity prices and projected incomes this year, there's a little bit of trepidation saying, you know what, those poorer farms, the ones with a lower productivity index, generally speaking, I don't have to own that today. I can basically say, I'll pass on that for now. Whereas 2 years ago, just buy whatever's available. And so I think that's what we're starting to see really reflected in the marketplace. Premium farms are bringing premium prices. And if you have a farm that's in a geographic location that's favorable due to 1031 exchanges, and we're going to get into that in just a second with Anna about how you execute it. But if you go around the city of Indianapolis, the city of Chicago, there's a lot of hype because the ag census data just came out and we lost X number of acres of farmland. A lot of those lost acres are to residential development or to some sort of economic development around large metropolitan areas. That leads to cash coming out as 1031 exchanges. So if you're around Indianapolis, if you're around Chicago, or in a corridor like I-65 between Indianapolis and Chicago, those values probably tend to skew a little higher for the productivity just because of the halo effect of economic development going on around them.
Got it. So this is okay. This is the exciting stuff. Trend line looks up.
Yeah. So why, if you own farmland, you hold it for the long term. Farmland is not a short term investment. It is a long term play. Buy today, sell tomorrow doesn't work in the farmland space. And so this is the long term trend going back to 2016. The last 8 years basically, or 7.5 years. And more volatile on the far right-hand side, but still a lot of great strength in the marketplace. And then, you referenced who are the buyers. Last year, 57% of Halderman buyers were farmers. I might argue that ours is a little lower on the farmer number than overall, because there's always those transactions, Damian, a broker's not involved in, where the landowner sells to his tenant, who's a farmer. And so that arguably is much higher than 57% of the overall marketplace are farmer buyers. So Indiana is looking to, I think, pass out of the Senate a new Foreign Ownership Investment Act. We've had one in place for a couple of years that restricted anyone foreign to the United States from buying in Indiana. That is now subject to being changed, and I think it's passed out of the Senate. that if the buyer is from one of 6 adversarial countries to the United States, you can't buy in Indiana. And there's a lot more teeth to that and a lot more traceability to that than what the previous law had. But if you're from a country that we're favorable with, think NATO, think Western EU, think South American countries, you're probably going to be able to buy here, which I think that's the right way to go with that kind of legislation. A lot of states have put different similar legislation in place, and Indiana has one.
That's a topic, by the way, that should be on the Business of Ag podcast, because I get asked that routinely in my travels. And my research says, of all things, Canadian citizens or companies own more than any other, which talk about countries we're friendly with. I mean, yeah, you're okay. You're okay if it's a Canadian outfit that owns a property in your township. If it's a Chinese organization, you're probably not real pleased with that. So this is the right
Yeah.
law.
So the 6 countries are, of course, China, North Korea, Russia, and then Iran, and that's 4. And then you got Cuba and Venezuela. So those are your 6 today. That obviously could change. You're right, Damian. 3% of the farmland in the United States, including timber, is owned by foreign people to the U.S. Of that, a majority are Canadians, and that's mostly timberland. The Chinese own less than 1% of all farmland in the U.S.
Yeah, it's pretty small. Okay, so ag economy barometer. Before we get into Anna, is this a real number or is this sentiment like we spoke about earlier?
This is sentiment. This is subjective. I always throw this chart up, and for a long time the market really traded very similarly to sentiment, and for the last 2+ years it hasn't. I worked all-time high of farmland values, and sentiment is arguably closer to the lower end of where it normally is. Now, the report came out this morning. It's 111, so it went up 5 points this last month, and they do it every month. This is probably a little closer to where commodity prices trade and where interest rates are than where long-term vision really lies. So if you want to put your finger on the pulse, this is kind of how farmers feel about today's agriculture, which honestly, with corn prices around $4 and soybeans around 11, I can fully understand why it's not that bullish. Farmland isn't purchased based upon near-term fundamentals. It is largely purchased off the long-term belief that it's an asset that is a great real asset. It's inflation sensitive, which we saw proven out in 2021. And over the long term, it's a great 6 to 8% returning investment.
Mhm. Yeah. So, and obviously we all know that there's a lot of the investor, the smart investors just look at it long haul. The more fickle, the cocktail crowd, non-ag people, they want to buy when they've heard that it's really hot, and when they really should buy is when sentiment is down. So now actually you could make the argument we're moving into a better buying time if sentiment matters.
Yeah, and one of the things to keep in mind is the sentiment today is low, maybe in the Corn Belt, because corn and soybean prices have come down. Honestly, in the Delta, I can see those land values holding strong or moving up a little bit because cotton and rice prices, I don't know if you've looked at those, Damian, but those prices are actually pretty attractive and will draw acres away from soybeans this year.
Right.
So it isn't just all areas of ag are weak. It is somewhat geography specific. So I think that's, where do I think farmland values, and I don't know why this says in 23, but I would say in 24, I should have changed the heading on this slide. We are calling cropland values steady. There are those that suggest down 1 to 5%. That's fair. I mean, if you want to argue the bearish standpoint, I can be bearish today because of commodity prices. But how quickly could that change, Damian? Have you looked at the rivers? Have you driven over any of the rivers in the Midwest recently? They're about as low as what they ever are in March.
Right.
And so we don't have an abundance of soil moisture. We're okay. Right. We're not declared abnormally dry yet on the drought index, but we're not far from that. And February here in Indiana felt a lot like February of 2012. So I'm not predicting a drought. I'm just suggesting that if we get into kind of weather challenges, you could see these markets change quite dramatically.
Well,
The
what's
other thing
interesting
that we're
because the person, Howard, is going to say, wait a minute, now you're talking about river levels. What the hell does that have to do with the farmland values? Well, when again, if sentiment drives it, and more importantly, sentiment sometimes is driven by commodity prices, and you just referenced 2012, when you go into a spring dry, you usually don't get wet from May 15th, from June 1st until August. That's usually the drying time, right? So your point is it's not unreasonable we put an extra buck on soybeans. It's not unreasonable we put an extra 50 or 70 cents on corn if you're talking about a 5-state area that does a lot of the heavy lifting, sees continual moisture concerns, that changes land value excitement, because when corn goes above $5, if it does, or soybeans spike above $12, it puts a little bit of shall we say, it doesn't put a floor under it, but it definitely it throws some excitement back into the air.
Well, and if in fact the Fed does take interest rates down 75 basis points, which is kind of their prediction, you
Yep.
combine that with just $5 corn and $12 beans. We don't have to go back to $6 or $7 corn.
Mm-hmm.
But you just get back to $4.75 to $5 and $12 soybeans. Those are profitable.
And 6% interest rates, or 6.5% interest rates instead of 8%, or something like this is what you're talking about.
Yes.
Yeah.
So that's where I'm going to call cropland value steady, because I still think there's a lot of cash generated from the last 2 years, pretty good years, farm income wise.
Yep.
And that's our prediction. Now, the other markets, timber, recreational, residential, those are going to be triggered off the general economy.
Yep.
I think it'll be interesting to watch the residential market. I think if you get long-term mortgage rates in the fives, something with a 5 in front of them, I think there'll be some houses come on the market, because there are a lot of people. Damon, you want to move. I want a new house. For whatever reason, my family grew, my family got smaller. I want a new house, but gosh, I'm not giving up this 2.5%, 3% mortgage.
Yeah. Yeah,
But
so interest rates, like you say, the guy and his wife that really want 23 acres with a stream going through it and some meadow and woods, they've been on the sidelines because 8% money scares them, or 7.5% money, and that's the same with. You could argue that rural, residential, and recreational probably walk down the aisle almost hand in hand. Now, the average to below average farmland, your sales data ferrets out that it's just not, like you said, 3 years ago, it would have still been being chased, but not anymore.
Yeah, we sold one a week ago, and it was in a weaker historic area, not banging on Pulaski County, Indiana at all. But we sold one up in Pulaski County that was pretty low WAPI score, 123 bushel. That's well below average in terms of the state of Indiana. And it brought $49. And so that's well below where the market has been. Had a lot of bidding. It wasn't like it was a lack of interest. But that's an example of one where folks just said, you know what, in today's marketplace, I don't need to own that one. And so that's the example where I'm pointing to here. That be cautious with those farms.
Yeah, so it had a lot of bidding, but it capped out. Everyone sat on their hands. I mean, there might have been a dozen people interested, but at a certain point, they all sat on their hands.
Yes.
Got it. All right, where do we go from here?
Well, I think we move on to Anna's presentation. We don't need to get into that. So
we did promise our listeners rent rates. Can you at least do about a minute and a half on rent rates?
And I forgot that. My apologies. So we bid out some farms in January. So, just a month and a half ago, Damien. And there we were looking at lower commodity prices at the time we bid them out. And I just throw this out as an example for our listeners, because you might assume, oh gosh, rents really have to go down. Rents tend to be very sticky.
Right.
And as an example, we had 3 farms. They were 300 acres each in 2 different counties here in Indiana, 3 different owners. One farm, the best farm, had 18 bids. So 18 different farming operations bid on that. The other farm in the same county had 13 bids. That's not a low number of bids.
No.
And these are all sealed bids. We don't auction rents off. It was just a sealed bid. All the rates were higher than where we had been the previous go round.
Okay.
So still excellent demand for farms to rent in 2024, based upon our observation And these were situations where the owner or the tenant decided to give something up, and there was a tenant change that had to occur. And so we were out, just, anybody and everybody could bid on this. And we had some bid. We had another farm in Illinois, and gosh, the bids were super strong on that, to where we had 9 or 10 bids, and they were all in excess of $400 an acre. So I just throw that out there because I want the listener to know that while you might feel like rent should be weaker, that's not necessarily what we're finding in the marketplace.
I'm going to share a link, by the way, listeners and viewers, to a Business of Agriculture podcast. I just promoted it via newsletter yesterday, and I'm going to put it in the chat. Howard was my guest, and we talked about cash rents. We titled it Cash Rents. Are you paying too much, charging too little? And very, very good data, and it's only a month old, so it's very current. And real quickly, I mean, you used the number in Indiana. You said we're pretty much staying the same. I saw one of your slides, I think, said we're talking about maybe $5 or something. If there's a deduct down, it's going to be mostly out of being congenial. It's not going to be because the market actually expects rent rates to go down. Is that an accurate statement?
That is correct. And Damian, we use a lot of cash flex leases.
Yep.
So we have a base rent and then a potential for a bonus. And that works super well in a market like this, where the last 3 years we've had, to many people's surprise, in a couple of those years, really good years. So some nice bonuses were paid to the landowner because they were earned. This year, we might not see a lot of bonuses, which from a farmer's perspective, their base rent is usually less in a cash flex lease than what if they paid fixed rent marketplace. And so I think that helps them to have a little less risk on the front end going into 24, because right now things don't look as favorable. If things turned out to be a successful year and there's profit to be made, then maybe they share 25 or 33% of that with the landowner over a certain hurdle rate. If it's not, then they don't. And so I think it's a little better way to risk mitigate for the farmer, and it gives upside to the landowner.
I just shared that link, by the way. Yeah, and the Holderman, you guys were kind of pioneers on the flex lease, where it's a base plus bonus based on profitability. It's, in business, when people talk about something being fair, I always say, well, fair is where they hand out blue ribbons to pigs and you eat cotton candy. What's fair? Define fair. But it is a situation that generally the tenant and landowner can get behind, because it's not like, oh, you gouged me, oh, things really changed, or at the end of the season you're trying to then hash out what would be a fair rate. The Holderman Flex lease does that. Okay. Well, anyway, good. I'm glad we covered that. By the way, if you have questions, type them in and we'll make sure we get them. I know the questions are going to come right now with Anna Barsky. Anna Barsky is a vice president with IPX, that is Investment Property Exchange Services, out of Chicago, Illinois. Anna covers Indiana, Illinois, and Wisconsin. A 1031 exchange, maybe you're like so sophisticated as an investor, you already know this. If you are not, you've not done one, don't be embarrassed about this. It's actually simpler than it thinks, and she can get way complex, but we're here to answer your questions. That's why Howard brought her in. Essentially, you're talking about you sell something and then you can not pay, you can avoid paying capital gains taxes if you rebuy. And then there's various methods and ways to make this work. And she's going to get into some of the more sophisticated methods. But essentially what you're talking about is you use this vehicle, this tax code, to defer capital gains taxes. And we were talking about $15,000 an acre farm property per acre. These numbers can be significant, especially based on what your basis is. If you inherited something 50 years ago and you're selling it, these numbers are pretty are worth hiring somebody like Anna. So Anna is been in this industry for 18 years. They've done a number of transactions in conjunction with Halderman, and he can get into that. And I'm not going to go on about the background on IPX, but IPX is legit. You can trust me. They are actually well, they're part of, if I get this right here, Anna, Chicago Title, Fidelity National Title, Commonwealth Land Title. In other words, title companies that you've worked with or heard of, and they affiliate. So Anna, you fill on what I missed, please.
Thank you, Damian. Thank you so much.
Anna, I want to.
Oh, and wait, Anna, Howard wants to point out how many years you've worked together?
Yeah, we in the late 90s, early 2000s actually did some 1031 exchanges in-house, where we found a bank that would be a qualified intermediary, and we did all the paperwork, and man, was that a challenge. The beauty of IPX 1031 and Anna is they do make it simple. They've got all the documentation. They tell you what you need to do and when you need to do it, and dot the I's and cross the T's. And I had a client, good friend of mine, that I had done a mission trip with. He came to me and he said, well, we want to sell this house. It was more residential and a recreational transaction. He ultimately then had said, well, I get a chance to buy this house and lot behind me, and I want to build a pole barn on this extra lot. Now, granted, this isn't an ag deal, but this is an example of the kind of complexity that IPX can handle. I said, well, I think we can do an exchange, Ray. And we ended up doing a build to suit exchange. And I'm not sure that's the terminology Anna would use, but it was really cool.
Yeah, it is.
Yeah. He was able to buy this other property. He's got a rental in the house. And then he was able to build this pole barn on this extra lot. And we did it all out of exchange proceeds. He was able to protect the capital gains tax on this extra land that he had sold next to his house. So it really is a slick transaction. IPX handles all the details. All I had to do was send a couple of emails to IPX every once in a while, and they'd send the check out to the vendor that we were paying for the building. So they do make it that simple, and we've enjoyed our relationship with Anna and had her present at other meetings before. So with that, I'm going to turn over to Anna Barski with IPX 1031.
Thank you, Howard, and thank you, Damian, and thank you everyone for joining the call today. Nothing like a little tax talk to really, get your energy going for the rest of the afternoon. As has been mentioned, I'm Anna Barski. I work for a 1031 exchange qualified intermediary called IPX 1031. Really excited to be here because I have been, working with Howard and his team for quite some time, and we really appreciate the business, really appreciate the relationship. And farmland specifically has always been a sector in real estate that has always been popular with 1031 exchanges. So it's, with exchanges and farmland, they've always gone hand in hand. And really the goal of today is to give just a quick overview of some of the basics. And I'm not going to go through each basic guideline one by one. What I've actually done is I compiled a list of frequently asked questions that brokers typically ask me about 1031 exchanges. And we did more of a basics kind of seminar a couple months ago. So in this seminar, I am going to dive into some of the more complex issues and topics that we see pop up in a 1031 exchange. I've been at IPX for 15 years. I worked for a different 1031 company prior to that for several years. So I'm a 1031 nerd, and I can probably sit on this webinar for the next 5 hours and talk about this stuff. I'm not going to do that. I want to talk about what's important to you, what's important to your clients, what transactions you may be seeing out there right now that could be a 1031 opportunity. So we can absolutely make it interactive and go off script. I do have a quick PowerPoint here, but we can talk about whatever whatever is important to you. So feel free to type in questions as I'm going along, and Damian is gonna kind of help me read and answer some of those questions.
And we already have a question, but I said we should probably get rolling. Unless you want to go ahead and open with a question. You want to open with it, or do you want to get going for a second?
Let's open with a question. Let's do it.
Actually, I would like you, for the person, remember it's the thing about the audience. The question is from Tony Crowell. He works in estate planning, and I've employed him. I'm glad to know that you're on here. I have utilized and hired his services. He's with Gordon and Associates, which does a lot of agricultural legal work. But I think it's important before we get into the weeds on that question, what you're going to do right now. For the person that's not Tony Crowell, that doesn't work in this space every week, what's a 1031 exchange, and why do I need one? How do I use one?
Sure. So 1031 exchange, it's called 1031 because it's part of section 1031 of the IRS code. So essentially our government says that if you're selling a piece of investment real estate or business use real estate, such as farmland, any type of residential property being used for rental purposes, any type of commercial asset, and you have a profit on that sale, you could defer paying the taxes on that profit by doing a 1031 exchange and essentially just buying another piece of investment property or business use property. So a lot of folks in our industry really try to overcomplicate these things. And there are some, rules you have to follow. But really all that a 1031 exchange is a sale plus a purchase equals a tax deferral. So again, our government says, hey, if you're selling property and you're reinvesting the money from that sale into something else, you're not going to have to pay taxes.
And by the way, because the person is probably listening as a farm person, if they're on the Halderman webinar, Maximize Your Farmland series, it is not unreasonable. Howard gave one example. If you owned a apartment building, you could sell it and buy farmland. If you sold farmland, you could take the proceeds, the proceeds from the farmland sale and buy a warehouse. It doesn't, like kind means investment. It doesn't mean it has to be Blount Pewamo soil type to this. I mean, it doesn't have to mean like kind gets people confused. Can you just do a little bit more on like kind, please, Anna?
Sure. So 100% correct. That like kind requirement is a little bit confusing because the rules say the property you're buying has to be like kind to the property you're selling. All investment in business use real estate is like kind to any other investment or business use real estate. So as Damien mentioned, you can sell an apartment building and buy a piece of farmland. You can sell an industrial center and buy a piece of vacant land. You could sell a rental condo and buy a, retail center. All investment real estate is like kind and can be exchanged for any other type of investment real estate. So a lot of the times folks use 1031s to either diversify their real estate portfolio, or maybe, especially sometimes this happens in the farming community where you have, family that's been farming for years and years and years. Parents are getting older, kids don't necessarily want to take over the farm business, and there's a lot of profit on that farm sale. So the farmland is sold and then they buy a different type of real estate to complete the exchange. Maybe they buy a commercial property, maybe they buy, multifamily if they're looking to get into that space. So you can really move into different types of real estate depending on what you're looking for from a cash flow perspective, a management perspective, location. All investment real estate in the US is like kind to any other investment real estate in the US.
Thank you for explaining. And also you can go backwards. In other words, probably the people on here already own farmland and they're wondering, if I sold this farmland that has this, huge capital gain, could I buy a condo in Florida for me to go and stay in the winter? Well, it's got to be an investment property. It can't just be where you're going to go and live, right?
So yes and no. They're generally speaking, personal use property doesn't qualify. So primary residence wouldn't qualify. Something that's 100% personally used doesn't qualify. But the IRS did specify, I think it was like 2008, 2009, some rules for vacation homes and second homes. So those types of assets do qualify if you are renting them and limiting your personal use. And there's also a 2-year holding period requirement for those assets. So it is possible. Again, it can't be 100% personal use. There has to be some rental, and the personal use does have to be limited.
Got it. And by the way, I did do one in 2018. I sold an investment condo that we had a tenant in that for 7 years, we sold it and we took the proceeds and put it into a chunk of farm ground. So you can go from farm ground to condo, or you can go from condo to farm ground, and it's completely legal, and you can then defer the capital gains tax. I think a question before we get into your common 1031 questions that somebody says is, why do I need you? Well, Howard touched on it. The Haldeman Company does real estate transactions every week, but they don't do the 1031 part of it, which has some nuances that are a little bit different because it has to comply from a legal and tax code standpoint. So maybe you could talk through just that, Anna.
Sure.
I sell my farm. I want to do that thing where I buy whatever, a warehouse, a apartment building, a condo in Florida, whatever that thing should be. Give me the very simple method. I think that's very helpful. Am I right here, Howard? Because this is probably some of the calls you guys get at HRES. You probably get the whole thing like, all right, I want to do this, but I don't know how to do it. And so I think a very simple walkthrough might be illustrative.
Oh, it's very helpful. Yeah, the question you get, nobody remembers the timing and when things start and the clock starts ticking and those sorts of terms. So Anna, walk us through that.
Yeah, so I would say the way that probably normally happens, from Howard's end or anyone on his team is, they found a buyer for a property that's being sold. The seller, who is a Halderman client, says, "Hey, I think I have some profit here." Howard would say, "Great, you probably want to do a 1031 exchange. You do have to buy another asset. We can help you buy some farmland, or if you choose, you can buy something else." That's done through a 1031 exchange. Let's get Anna on the call, and then she can walk through some of the basic guidelines. And then I'll go through, okay, here are the time periods. Here are some of the rules that you have to follow. And one of the rules that you have to follow is you have to hire a 1031 exchange qualified intermediary. That's what our industry is called. And the main reason you have to hire us is because the IRS says if you're doing a 1031 exchange, you cannot touch the proceeds from your sale. Once you've had constructive receipt of those funds, they're automatically taxable. So one of our roles in the exchange as the qualified intermediary or 1031 company is we set up a 1031 escrow account to hold the money in between the closing of the sale and the closing of the purchase. We also draft all the 1031 documents and forms that the IRS requires. So we don't replace the title company, we don't replace the attorney or the broker or your CPA. We're kind of the added piece to the transaction to make that sale and purchase a successful tax deferral.
The rules, you obviously make sure that everything's crossed off, and that's the bigger thing, is that there's a certain amount of relief when you say, "Hey, once I talk to somebody like Anna, I know that this is being done right, and you're keeping me legal," because you're talking. It could be, $1 million of capital gain at 25. What is, I don't know, capital gains. Are they 20% right now? Something like that. Is that what we are long
Yep,
term?
15 or 20, depending on your income. Yep.
Okay, so you're talking it could be $200,000 on $1 million of gain that you're deferring the taxes on. And so there's a lot of relief going to somebody like you and saying, I know that I'm not avoiding it, but I'm deferring $200,000 of capital gains tax, and I don't want to be in a fix. I just heard the IRS hired 80,000 more people. The last thing I want is to have them
That's right.
coming after me. So that's where I think the big thing is with a firm like yours.
So
Exactly. So of course we make sure that the account structure and our documentation is compliant with all the regulations. We also do really serve in an advisory role, right? So a lot of the transactions that we handle involve some type of a complex issue. Like Howard mentioned, his client did a built to suit exchange, right? That has to be structured in a very specific way in order for the funds that are being dispersed for those improvements to also qualify for tax deferral. So those are kind of some of the fun transactions that we get into. And if we have a little bit more time, I'll get into some of those kind of more complex structures and exchanges that we do, such as improvement and reverse
Yeah.
exchanges.
And we're going to ask some of those questions, but we're going to get through some of the simple stuff. And Howard has a point or a question.
Well, I was just going to say we have added to our purchase agreement a statement that's a standard pre-printed statement that the seller may elect, who's typically our client, may elect to do a tax deferred exchange with their proceeds. And the buyer agrees to cooperate. Doesn't cost the buyer anything. So first of all, your buyer in your transaction is not going to pay any of these 1031 exchange costs. And by putting that statement in the purchase agreement, having it pre-printed, whether you do a 1031 or not, doesn't require you, but it shows the IRS from the very outset of your transaction, you intended to do a 1031 exchange. And then Anna, and tell me if I'm wrong on this, but you get to closing. What do they need to do before closing, and then what are the timelines after closing?
So the funds have to go directly from the closing table to the 1031 escrow account. So prior to closing, we want to make sure that account is open and available to receive funds. So we want to get that account set up prior to closing. And in order for us to do that, the seller has to sign a package of 1031 documents. So usually once we receive the information that we need, which is simply the purchase and sale agreement between seller and buyer and the title commitment, we can draft the documents within 2 business days and set up that exchange account. And then we will continue to coordinate with the closer to ensure that that money gets wired directly to us. So then the first phase of the exchange is kind of done, right? The sale has happened, the money's in the 1031 escrow account. And from that point, there's 2 1031 clocks that start. The client would have 45 days from the closing of that sale to identify new property, and 180 days from the closing of the sale to purchase one or more of the identified properties. You can only buy what's been identified within that 45-day window. So that's why that time period is very critical and usually the trickiest part of the exchange for most clients.
Okay, and I think that because those are just because I've been asked, and we see this in ag, and Howard probably sees it with 1/4 of his clients or more. The numbers again are, if I'm the seller and I have proceeds to do something with, the good news is if I'm working with Halderman, they're going to put in the documentation that I intend to do a tax deferred real estate exchange, and then identify the agency. Is that the right word for you, Anna?
Intermediary, yep.
Intermediary, and then I have to, within 45 days of the gavel, identify, it's 3 places that I may be taking the proceeds?
So 3 is kind of the number that most folks use, because if you identify more than 3, there's some rules that come into play that limit the identification. If you're identifying 3 or less, the properties can be any value. If you identify 4 or more, the total value of what you identify can't exceed twice the value of the property that you sold. So that's kind of where the limitations come in if you're doing more than 3. Let's say you sold property for $1 million and you've identified 5 properties. The total value of those 5 properties can't exceed $2 million, twice the value of that $1 million sale price. So that's kind of the tricky part. It's called the 200% rule. If you're going 1 for 1, you're going to identify 3 or less.
Okay.
If you're someone that is selling one big property and looking to buy up a couple smaller properties, then that 200% rule may work in your situation.
Got it. So I have 45 days upon the time that the gavel hits, let's say on a sale, to identify up however many, but generally it's 3 properties, places I might go with it. So I have to be specific. I can't say a condo in Florida. It has to be the condo at 2913 Cortez Avenue in Boca Raton, whatever. I have to be that specific. It has to be the specific place, correct?
Specific and unambiguous, correct.
And then same thing
And
if I'm going
Damian?
from farm to farm. Go ahead, Howard.
Well, you mentioned when the gavel falls, that would not be true. The
Oh,
gavel
it's when
falling,
it's when this closing.
exactly. So I don't want to confuse folks. When the gavel falls, that's when we sign the purchase agreement. That starts the process. But when it's closing, and when the day of transferring deed and transferring money happens, that's when the 45 days starts.
So the great thing
That's
is,
correct. The closing is when the clock starts ticking.
thank you. That's very important. Now, what that does for the seller, it gives a little more time because now you have at least a purchase agreement that you assume you're going to be selling. And so you've extended your 45-day at least for the research and the process. Is that an accurate way to look at it? You can start kicking the bricks during that time and your 45-day clock doesn't kick in.
Yeah, and actually, Damian, we encourage sellers, especially if they are, here in Indiana, Boone County, Indiana's been a lot of transactions been offered from the state to buy a whole lot of land for economic development at pretty big prices. So some of those folks are wanting to do 1031 exchanges, and it behooves you, if you're in that situation, to start early. Even start before you sign a purchase agreement, because if you can identify or have some things lined up, as that takes the pressure off. Because we have seen folks show up at some of our auctions as buyers where they're under the clock, so to speak, and they're on the 40th day of their 45th, and they become a little more aggressive. Let's say
By
that.
the way, I was just going to say, if you have another one of those and like they come and say, I've got to get something bought in the next 3 days, just call me directly. By golly, I could probably figure out some way to make this work because I like people that are desperately trying to spend lots of money. Okay. And then the other time period, Anna, you said 180 days. Once I've identified the whatever it is, I'm going to buy storage units with the proceeds from my farm. I'm going to sell storage units and buy farm, whatever that thing is. I'm going to sell farm, buy farm. Sell farm in Lebanon County for development. I'm Lebanon, Indiana for economic development. I'm going to buy a farm. I got the 45 days to identify after the close, and then I've got 180 days to get it done. Is that the deal?
Exactly. So you have 180 days from the closing of the sale to close on one or more of those identified properties.
Okay.
So Anna, we had a great question. The question came in from one of our clients. He asked, can you include irrigation equipment as part of the exchange? So you're selling the farm for $1.2 million. You got $1 million in real estate and you got a 200,000 in an irrigation center pivot. One might argue the pivot itself, the unit that's on top of the land, is personal property, not real estate. The well, the pump, those things attached to the land are probably real property, but that irrigation unit might not be. How is that interpreted in an exchange?
Yeah, so in 2017, the IRS cracked down on what types of assets can be exchanged. Now you can only exchange real property. So any type of personal property doesn't qualify for 1031 treatment, unfortunately. Each state, it's kind of a state by state law, what's considered personal property or not. You also have to look back to how the asset was depreciated, because personal property and real property are depreciated differently. So more often than not, an irrigation system, something that's not permanently affixed to the ground, would be considered, equipment like that would be considered personal property, not real property, would not qualify for the exchange.
And then Tony had a question.
Yeah, I'm gonna get to Tony's question. I think I want to go ahead and address the thing that you and I are both thinking, Howard. When Anna introduced herself, she referred to herself as a 1031 geek. And if anybody questioned that, her discussion on personal property 2017 legislation and center pivot irrigation units definitely answered the question. You're right, Anna. Your description of yourself is accurate. Tony Crowell of Gordon Associates, he's an attorney, says in a build to suit, does the title to the replacement property need to remain in an EAT, don't even know what that is, until the construction is complete? So the thing that Howard referenced earlier about his client friend that swapped stuff around, built a pole barn on part of the property, et cetera, built a suit complying with 1031 tax deferred exchange. Can you go into that, please?
Yes, so an EAT is an exchange accommodation title holder, and that is what we are in an improvement exchange. So the way that the regulations are written for that type of transaction, the IRS doesn't allow the exchanger, the taxpayer, to be on title to the property while the improvements are being made. So we, the EAT, are on title. We're the title holder of that property during the exchange period, during the construction. To answer the attorney's question, we're only on title for 180 days, right? So kind of to backtrack, in order to get the full benefit of the exchange, I know we haven't gone through some of the rules yet, but in order to get the full benefit of the exchange, you have to buy property of equal or greater value. So if you're selling property for $1 million and you buy a piece of land for 400,000 and you're looking to do an improvement exchange, you'd have to put $600,000 of improvements onto that property to get to the $1 million value within the 180-day period. So whether you're doing a regular exchange or an improvement exchange, it's 180 days max. So we would not be on title for the entire construction project unless it is complete within the 180-day period. It doesn't have to be complete within the 180-day period. We just need to get to some value where we're either getting full deferral, hopefully, or some partial tax deferral. And at that day 180 point, we would transfer the improved property at the escalated value back to the taxpayer.
Howard, I think you wanted to go over to the questions because we still have a couple more on that topic. Yes.
I think we answered all
well,
those.
We've got Eric Ashleman that asked, can you still do a reverse 1031 exchange? And then Tony replied that yes, you can. And they're talking about that prior example, but they're talking over there because they're obviously in legal speak. For the rest of us, what is a reverse exchange? I think that's probably a good chance to reverse 1031.
It's actually a good segue from the previous question, because the structure that's put in place for an improvement exchange is very similar to a reverse exchange. So a reverse exchange is when you're in a situation that you have to close on the purchase before you're able to close on the sale. Maybe you don't have a buyer for the property that's being sold. Maybe you do have a buyer and the buyer says, oh my gosh, my financing fell through. I need to find another lender. And Howard has found the client the perfect replacement property. And the seller of that property says, well, I have 4 other offers. So if you want to buy my property, we have to close in 30 days. And you're in a position where you have to close on the purchase first. That is a reverse exchange. Again, the way that the revenue procedure is written for reverse exchanges, the IRS doesn't allow the client to have ownership of both the old property and the new property at the same time. So just like in a improvement exchange, in a reverse exchange, the EAT, us, the 1031 exchange company, also has to come into the chain of title. So just to give kind of a quick summary of how this works, and I do have a slide on it that I could pull up. The slide is some say the slide is helpful, some say the slide is confusing. It's a little bit of a chart.
And I got to point out, you had like 40 slides and you've kept like one up there for 25 minutes. So I was about to
I
complain.
love that.
I was about to complain. All right. So, yeah, I think this is a neat thing.
This is the first phase of the reverse exchange, right? So the seller who is selling the replacement property to the client is actually now going to sell the replacement property to the EAT, right? There's the EAT. The EAT is essentially us. What we do in this scenario is we set up an LLC for every new improvement exchange or reverse exchange where we're taking title. We form an LLC. We are the sole member of the LLC. The client is the manager. Okay. The client either takes out a loan, a lot of the times is done with a bridge loan, or if they have available cash, that cash is loaned to the EAT. So exchanger loans the EAT the money, either through debt or their own cash. And then the EAT actually buys the replacement property from the seller. So here we are on title to the client's property. In a reverse exchange, the clock would start at the point of that acquisition. So from the point of that acquisition, the client would actually have 45 days to identify what they're selling, and they'd have 180 days to actually close on the sale. So again, time periods are the same. All of the rules are the same. It's just the process is different because the IRS requires us to be on title to the property. This is the second phase of this reverse exchange, right? So the client identifies what they're selling. Usually that's easy because they know the property they're looking to get tax deferral on. And then once the sale takes place, the client sells their old property to the buyer. The funds from that sale would come to IPX as the 1031 exchange company. And then we would use those funds to either reimburse the client for any cash that they put up, or we would use the funds to pay down the loan that they took out to have us buy the property. Usually it's a combination of both. And then the EAT would transfer the property to the client. So it's a little bit of a like smoke and mirrors, right? Because the IRS says, hey, the client can't have ownership of both the old property and the new property at the same time. So we're kind of stepping in, we're taking title. So it looks like the client is selling and then buying from us. It's kind of the fiction that's worked around the regulations in order to allow for this reverse exchange.
And I don't know if we need the 1031 expert saying it's kind of like smoke and mirrors. I mean, it's illegal. It is a perfectly legal apparatus,
yes.
And it is how you do a reverse exchange, right?
Yes, there was a revenue procedure that came out. I think it was either 2000 or 2002. And folks were doing reverses before then when it wasn't necessarily legal. There wasn't a safe harbor for it. That's what we call it. There's, so now there's a specific revenue procedure, which is law, that says here are the steps that you need to take in order for a reverse exchange to be a valid tax deferred transaction.
And by the way, it seems like this is something that when I first learned about this 20 years ago, it wasn't really, it seems like it's definitely needed because there's a lot of situations, I'm sure Haldermans get this, where it's, I'm buying this because it came available, but I'm going to sell that and I haven't got it sold yet. I mean, I can see those kinds of things happening quite a bit. We've got a question. Got a question from John Russell. If you get a 1031 shares in an REIT, a real estate investment trust, can you reverse the shares and get farmland for the shares?
No. So you have to be selling fee simple interest in real property and buying fee simple interest in real property.
Define that for the non-1031 geek. You just said fee simple. Please define that. or
An
expand?
interest in real estate. So if I am selling a piece of property and I'm buying a piece of property, fee simple means that my name is on the deed. I own that real property, right? So any type of like partnership interest, shares of a corporation, membership interests of an LLC are all similar to like REIT shares, doesn't qualify for 1031. So even if the actual entity owns real property, the individual owners of the entity who own shares of that entity, shares of a corporation, partnership interests, cannot participate in a 1031 exchange.
Now that's really interesting. So that is very understandable for a real estate investment trust. But if we have somebody that's listening or that will watch the recording and they say, I own this farm with my 3 siblings, that does that okay, so me and my 3 siblings inherited this land and now it's worth, $1 million. It was worth whatever, we're gonna face a pretty significant amount because we've owned it for 30 years. We
Sure.
go to sell it. Don't I qualify? If then my 250 of whatever, if I'm one of the 4 owners, does that qualify me? Is that fee simple personal ownership?
It depends. So you said it's you and 2 siblings, correct?
Hell, I don't know. I just made it up. Actually, I
Okay,
don't
so
know
you
anything with
and
my
2
siblings. If
siblings.
you
Let's
met my
use that
siblings, you wouldn't
example,
know anything
right?
with them either.
So if we look at a deed and the deed shows that Damien, sibling 1 and sibling 2 are all in the deed, we have 3 owners, then each owner has a piece of real estate, owns an interest in the real property. Then everyone can do a 1031 exchange very, very easily. One can do an exchange, one can pay taxes. You guys can do separate exchanges, no problem. But if I look at the deed and it says, the Damien family partnership, and Damien and his siblings are partners in the partnership, then the various partners, Damien and his siblings, don't have the option of doing their own 1031 exchanges because the partnership owns real property. The siblings own an interest in the partnership. So the partnership can do an exchange because, again, the partnership owns real estate. They have the deed, right? But the individual partners own an interest in the partnership, which doesn't qualify for 1031 treatment. In the instance of a partnership entity on title and the partners not wanting to stay together, which does happen very often, there are some structures that we can put in place in advance of the closing, hopefully very far in advance of the closing, in order to allow the folks that want to do an exchange to have the opportunity to do so. But there has to be a lot of restructuring done in order to make that happen.
Wow. Okay. By the way, Howard, I'm guessing you get that sometimes where it's
Oh,
three
yes.
three heirs, siblings, and this kind of thing. And so how it's structured, that's kind of a big deal. The partner, by the way, you said a partnership can do a 1031, but it's specific to that partnership. So the 3 partners, 4 siblings, whatever they are, that are Mason sibling partnerships, whatever, they've got to go and do the thing together. Although I'm assuming that you could within that buy out your partner, I'm guessing.
That's one of the options. Yeah. And I mean, I can absolutely get further into like partnership structures that we have seen. But I think the important takeaway is any type of entity, any type of taxpayer can participate in a 1031 exchange. So a partnership owns real estate, the partnership could sell the real estate, the partnership would do the 1031 exchange. But the various partners within the entity, they don't own real estate. They own an interest in the partnership, which doesn't qualify for the 1031. It's a very minor point, but it's a very important point with 1031 exchanges because one works and one doesn't as far as, what's exchangeable and what's not.
Fantastic. We are getting good questions over here. Howard, did you have something before we take Michelle Cox has a question?
I would go with Michelle's question, and then we got a couple more that came in. So go ahead with Michelle's.
She asked about hog barns, and this would be it is real estate. It's improvement on a real estate, and it is an investment property. So I guess you can dig into that. And if they're selling hog barns and then buying and building on another tract at a lesser or same value, can they use the intermediary, meaning you, along with the builder until the construction is complete, or do they have to use an EAT? So lesser or greater value, and this is getting a little pretty complex here, I would think, but kind of
So
stuff you deal with.
So an important point to make in an improvement exchange, you can't build on land you already own. So you have to buy the land within the exchange, have us buy it, have the EAT buy it, and then do the improvements within the exchange. So I want to make that clear. You cannot build on land you already own, generally speaking. I think her question was, do we have to go through the EAT process? through the improvement exchange process? I think that's what the question ultimately is. And the answer is yes, right? So if you're looking to use the proceeds from the sale of a piece of property to buy another piece of property and do the improvements, the proceeds from the sale are being dispersed strictly to make improvements, then you have to go through the EAT process and the improvement exchange process. There's no way of getting around that.
And
And then-
Damian, James Miller asked the question, how about a farm held in an LLC? I would, one of the things I always stress to clients, if you think about a 1031 exchange, you have to take title to the replacement property the same way you have title to the property you're selling. And it doesn't matter if it's a partnership or an LLC or a C Corp or an individual. If you're doing the trade, you have to take it in the same way you hold title today. And that's a simple way to think about it, because if, as Anna said, if Damian owns a share in an LLC, Damian can't do an individual trade. The LLC can do the trade, Damian can't as a shareholder. If you own title 3 ways, and that's pretty common, you get a tenants in common deed where 3 siblings own a farm, Damian could trade his third and the other 2 wouldn't have to. But in all other instances, basically that whoever owns the land has to do the exchange, or the property, I should say.
Or even, and you said, yeah, because to Anna's point, it could be a partnership, Howard. It could be
Yep.
an LLC. So the entity can do it. It's
Yes.
just I think where it gets sticky is if it's one member of the entity, the LLC is owned by 4 of us and only 2 of us want to do it. That's where I think the complexity comes in on somebody hopping in or out of it. And Anna's nodding her head. So go ahead and expand on that just a little bit.
Yep, 100% correct. Yep. The tricky part comes in when some or all the partners don't want to do an exchange or don't want to do an exchange together. Like they don't want to stick together, whatever the situation is, whether someone wants to cash out or someone wants to do an exchange, but not with the other folks. That's when you have to do the restructuring of the entity.
And I'm glad you're on here, and I'm glad you are the self-admitted 1031 geek, because we're getting some really good questions. I wondered, when Howard set this topic up, it's Teresa asks, if your farm has multiple parcels, can you do separate 1031 for each parcel? And I'm wondering, the motivation there might be maybe to not get into that whole convoluted thing about 200% and 5 things. I'm wondering if that's the reason. So Teresa, maybe type in why, just out of curiosity, why that would be, what the goal of that is, but go ahead, Anna, that's a good one.
Yeah, I mean, I don't see why not. I guess, it depends on the situation and what the sale looks like and what the contract looks like. I would say, in a very conservative approach, what some tax folks may say is, hey, if these are contiguous parcels that have been managed, by one entity and you have one contract and one buyer, that's really one 1031 exchange. And if we're splitting them up, that's so you can have more flexibility with those identification rules, which may be like frowned upon. But, if they are truly separate sales, we have separate contracts, maybe there's even separate ownership, then those can absolutely be separate 1031 exchanges.
Howard, is there any, do you want to shed any light on that? Would that be because this parcel's worth $500,000, I've got a place to go with it, and this one's worth 400 grand, I've got a perfect place to roll that money? Do you think that's the motivation for dividing it by parcel? I'm just curious.
Well, you could have a couple of avenues there. One would be that motivation. The other would be, it would be very common in a residential takedown situation or a development where a developer wants to buy this 100 acres today. They want to buy the next 50 acres in a year because they don't want to put all that cash out up front. And so I think, and Anna can answer if this is wrong, but I think in that case, if you had purchase agreements for the individual parcels separate from one another, and they were different transactions and different timing, that probably qualifies to do different 1031s.
And you would absolutely have to do different 1031s, especially if you have that much time in between, right?
Yeah. Yeah. So it's the sticky thing, I think what Anna was describing is if you had one purchase agreement for a 400-acre farm, and then all of a sudden you want to do 4 exchanges out of that, and it was all going to close at the same time to the same Yeah, and now Teresa's answering. She was trying to buy multiple parcels of lesser values. So really, Anna, to answer that question, then to do it, they would really need to have multiple purchase agreements, maybe different sellers, or at least different timing, correct? To qualify for multiple exchanges.
Yeah, I mean, I'm not saying you can't do it. I would just, if someone were to send me one purchase agreement, with one purchase price and one buyer, and, tell me, hey, we want to, divide this up into separate exchanges, I would say, yeah, no problem. We could do that. Check in with your CPA that they're comfortable with that, right? Especially if you're dividing it up into 3 exchanges. Now you have, 9 identifications, right? Which definitely, makes things a little bit easier. The IRS may frown on that if you were to potentially, get audited. So I would just say, hey, check in with your CPA, make sure they're comfortable reporting it that way, because ultimately they're signing the tax return, right? Then I would have, if your CPA is cool with it, I'm cool with it.
I think that Teresa, we just found that she's got Anna has a client and Howard has a client. But yeah, what I think the simple answer there is because, like you said, making them separate transactions or separate sales, so that then she has this one to move and then this one to move, and that's what I think
Sure.
we're hearing here, right? Because if it's all in one huge gob, it's got to go together, and that's getting almost may circumvent the rules. Anna,
That's right.
And she asked the question, what would be the best way to sell one high value farm and get several smaller investments? Some of that, you could do it compartmentalized the way Anna was just describing, especially if your CPA signs off of it. But the other thought would be this: if I've got a $10 million farm and I want to buy 5 $2 million replacement pieces, let's start the process today. But the thought is we're not going to close on that $10 million until you get down the road. Now, if you, the way Anna described it earlier, if we started today and you're not going to close on your $10 million transaction until October, let somebody like Halderman go to work and find 5 replacement properties for $2 million each and line them up. And then we can actually close on the $10 million deal and close on the 5 replacement properties the next day. Yeah. And you do, effectively 5 different exchanges into that. You're still in compliance because you're under the 200% rule, even though you did 5 transactions. So it can work, but that requires the prep on the front end and identifying more properties up front so that you can do the smaller investments. That might be a better way to do that than trying to be a little bit in the gray area. I think what Anna was describing when we take one purchase and divide it 5 ways.
Yeah.
I couldn't agree more. With any exchange, you want to plan ahead as much as possible and get, someone from, Howard or his team
Well,
to
if you're talking
jump on it ASAP.
and Anna and Howard, if you're talking about, let's say it was, she just said high value and, whatever, let's just say it was 10 million. That's a lot. But the other thing is to then say, we've got these other ones lined up and ready to go. The only thing is for those other ones that are lined up and ready to go, did they say it's lined up and ready to go as long as you give me a deposit, because otherwise I'm not there. So then there might be some work on some of the, the cash flow might be involve another layer of planning.
There's no issue with signing a contract or putting earnest money on replacement property at any point. So you could do that before the sale closes. You could do that before you've set up the exchange. That's not an issue at all. You want to make sure the closing of the sale occurs before the closing of the purchase. Otherwise, it's a reverse exchange. But signing contracts, earnest money, that doesn't trigger anything for the 1031 at all. So plan ahead as much as possible. Get that replacement property locked in.
Yeah, so it's all about when the close happens. That's good. Got it. Anybody else have any questions? This has been a great one. And then if there's any other things that we didn't get covered that you need us to get to, by the way, are there little like red lines or something on this one here? Are you making marks on this one, Anna?
I did not make the red lines. I have no idea. I was just looking at the same thing. I'm like, I have no idea where that came from.
Well, put a different slide up because this one's it's got marks on it.
The other question, Damien, we had, and he had to drop off. Grant Belden asked the question, financing impacts. If you sell the property, should you do a quit? I assume he meant quit claim prior to give more flexibility on financing options. thus not selling in a legal entity, forcing you to buy a new property with the same legal entity. I'm not exactly
and
sure.
I will, Howard, I will correct a small part of what you said earlier. The title holder doesn't necessarily need to be the same. The rule is that the taxpayer has to be the same throughout the exchange. So if I'm selling property in my individual name, I could buy my new property in a single member LLC, in a revocable trust, and that works because those entities are passed through for tax purposes, and I'm still the underlying taxpayer. So it doesn't necessarily have to be the same title holder, kind of a minor point. And I'm not sure I understand this question. So it was the question that if you do have an entity where the partners don't want to stay together, do we deed out of that entity? Was that the question?
Maybe. Yeah, and he's not on anymore, so I don't know exactly where he was going with that, but it's, yeah, do a quick claim deed, I assume, prior to the closing to give more flexibility on financing options.
On financing options. I mean, financing options aren't really, an issue for the exchange, I guess. But generally speaking, you don't want to change the taxpayer right before you're doing a 1031 exchange. I will say that I have seen situations where there's a husband and wife and they own property in an entity. So that entity is the taxpayer. And then they're looking to buy, a second home or a rental property to complete the exchange. And the lender does say, like, I could give you better rates if you are buying in your individual names. Maybe that's what they're referring to. Generally speaking, it is not recommended to change the taxpayer deed out of the current taxpayer into a new one shortly before the closing if you're doing an exchange.
Yeah, I think that's the key point there. Then maybe one last question. Why does the IRS allow or encourage this deferment in collecting their taxes, which could be a tax deferral of several years? So this goes back to legislation, right? Congress put this legislation in place?
30 years, like 30 plus years ago, isn't it?
So, I mean, there's a lot of reasons, but 1031 exchanges actually really enhance the economy and they promote reinvestment back into the US economy, right? Because if you're selling a piece of property in the United States and you do a 1031 exchange, you are going to have to put that money right back into another piece of investment property in the United States. And the reason that it encourages so much economic activity is because there is a sale and then there's a purchase, right? Every sale requires another transaction. When you have a real estate transaction, think about all the professionals that you hire to make that happen, right? You got to hire your broker, you got to hire your title company, you have an attorney, you're hiring us, right? All those entities get to work on that transaction, get to, make money, get paid. Usually when you're buying a piece of property, you are going to do some type of improvements, right? So you're going to go out and hire someone to put up a fence. You're going to, do whatever. So it really encourages us to spend more money, which the IRS likes. It's funny because usually I get the question like, why is it so hard to do these? This 45-day window is so short. And my answer is, well, because they do expect that some of the tax revenue, they do expect some tax revenue. Sometimes you will be, have a failed exchange because of the 45-day window and the IRS will collect those funds. So, it's a little bit of both.
I was afraid we were going to get I was afraid we are going to close out this webinar getting political, but there's the argument that 1031s have propped up values because the person like Howard referenced that has proceeds and would rather overpay than pay capital gains. And so there has been that. And you hear that not only from farmers, you'll hear from people that own warehouses, storage units, apartment buildings, whatever, because they wanted to buy something and a 1031 money came in. But this has been going on didn't this tax code go back to early 90s?
Well, it was originally in the tax code of 1920.
Oh, okay.
Yep. Yeah.
Right.
So it's been used for decades and decades. It's often seen as the last, tax loophole out there for real estate investors. But it really is the only way when you're selling any type of investment property to have this great tax strategy. And I always say, if you're selling and buying, there is no reason not to do an exchange, right? Rather than give that money to the government, you just reinvest that money into a newer, bigger, better property.
One of the things that I want to make sure we got another question. I don't know how long we want to go, Howard, but we might as well. We got good activity from the people that are staying on here. But one thing that I think is important, um, in one of the experiences I had, if you say, "Well, I'm only going to make 100 grand on something," that's only 20% to 20 grand at 20% capital gain. Why fool with this? It's not just the 100 grand you might be making on appreciation. If you've taken depreciation on a property, you have to capture that. And that could end up being hundreds of thousands of dollars. And I think that's important for people in farm country that, and I think Howard can speak to this as well, where you've done some of the things you're allowed to do with the tax code to do depreciation, et cetera. So even if you think you're only going to make 100 grand, remember, you're also going to maybe have to recapture expenses and depreciations against something that could end up being 2, 3, 4 times what you think your actual tax obligation is on capital gains. Can you speak to that?
Yeah, so it doesn't really apply so much in farmland transactions because you can't depreciate land, right?
But improvements.
But yeah, generally speaking, when you own a piece of improved property, you spread the cost throughout the time that you own it by taking a depreciation on your tax return. And when you sell the property, the government recaptures some of that depreciation through tax. So depreciation means that one, your profit is going to be higher. And two, the portion of that profit that is due to depreciation is taxed at a higher rate. It's a 25% depreciation recapture rate. So a lot of the times when we talk about clients are like, well, how much tax am I really deferring? To your point, Damien, it's like, well, once you factor in, if you've been aggressive with your depreciation, you factor in the 25% depreciation recapture, you factor in your capital gains tax of 20%, state taxes. When you kind of roll those up, again, depending on how much depreciation you've taken in the state that you're in, you're saving anywhere from 28 to 35% in taxes on the profits from the sale, not just the 20 due to the capital gains tax. So it's a good point, and I always tell people, I'm like, before you just cash out, crunch the numbers with your tax folks, really see what that tax liability looks like. It could be a lot higher than you think.
One more question, Howard, do you want to grab that?
Yeah,
You
we
have
had another
anything?
question. Is there any benefit to change a C Corp ownership to an S Corp ownership before a land sale? Or is that tax benefit of that disappeared over the last 10 years?
I don't know. There's no benefit as far as 1031 is concerned.
Yeah, and I'm not an accountant. I probably shouldn't even wade into it, but I think you need to talk to a professional before you would even consider that, because I think you have to change, first of all, from a C to an S. You maybe have to own it for 10 years as that S Corp to even have it qualify. Otherwise, you could be looking at double taxation as a C Corp. So I would recommend a lot of caution there and talk to your accountant and attorney before you venture down that path.
I think we're going to close on questions. We're pushing an hour and a half. It's been a great discussion. Anna, you want to close out of your slides and then tell us, maybe get to your closing slide. If somebody has a question, how they can get a hold of you.
Sure.
Do you have a closing slide with your contact information?
I think I do.
I want to hire you. I haven't even sold anything. I want to sell something and buy something just so I can do business with you. That's how excited I am about what we covered today.
Well, thank you.
Damien, we have had people request the slides. So Anna, if you will send the slides to me or Nolan, my slides are always available. So I think we can share both, and that way folks can have those. Plus, we did record this today.
Yeah, we did.
Yeah, I'll absolutely share the slides. My goal is to be your 1031 resource. So although it would be great, Damien, to work with you in the future, even if you don't have a deal on your desk and you are, brainstorming on a 1031 exchange that may occur when you might sell something down the road, or you're a broker that wants to use 1031 for your marketing purposes, feel free to give me a call. I'm happy to walk you through the guidelines, also walk through how you can use 1031s for your marketing purposes. I've been, doing this for a really long time, and the folks that really kind of, get us involved early in the process absolutely benefit the most. So again, you don't have to have a deal on your desk to reach out to me. My contact info is on the slide. I'll also have Nolan pass it around, and I look forward to hearing from you soon.
Got it. And
Yeah,
Michelle asks, is there a recording? And Howard just addressed that. Yes, you'll be able to get a copy. You can see this recording. It'll be, Howard, on the Holderman site within the next day.
next couple of days, yes.
Got it. So her name's Anna Barsky. She's awesome. She's with IPX 1031. You've got her contact information right here. I know I got to travel to Colorado. I'm going to be just like calling people on the way to the airport trying to buy and sell stuff just because I want to do business with you. Anyway, and of course, we always want to do business with Halderman. The Halderman Real Estate and Farm Management Company puts on awesome online webinars. Our next one is coming up in June. The exact date is to be determined, but it's going to be in June. It'll probably be a Tuesday in June, just like we've covered cash rents, land values, and 1031 exchanges here. We're going to talk about something that's probably a bigger topic than you think to dig into. Pun intended. 'Cause we're talking about tile drainage. We're talking about, is tile drainage a good investment? How should you go about doing it? We're talking about tile installation and upgrades. Farm economy might be going down. Is that the time to spend money on capital improvements? Probably it is. We're going to talk about all that. We got experts coming on to talk about tile drainage, the right way to do it, installation costs, more importantly, the business side of putting drainage and capital improvements into your farming operation. That's our June webinar. Mr. Halderman, what do you think to get us out the door?
Hey, I think farming is a great place to be. What's exciting is that we're at the advent of spring, and every crop year is an exciting year. I've had a lot of farmers say, you only do this 40 times, 50 times in your lifetime. And each spring is one of those few opportunities. You think about basketball players going to shoot 40 or 50 free throws in practice in a given day, and yet a farmer gets 40 or 50 chances in their lifetime to do this. So it's a pretty cool time of year, and it's always enjoyable to be out in the countryside as we plant a new crop and look to do our part to feed the world.
It's an exciting time. Thanks for being here. Till next time, I think we can hit stop the recording. Thank you, Anna, and we'll see you in June to talk about tile.
Thank you all.